So from here on out, we're going to show a presentation that Gonzalo is going to give, running through some basic ideas of finance. What are some of the components of profit and loss, balance sheet, and get some of his perspectives on that. So we're going to go ahead and share the screen and go into Gonzalo's presentation.
Okay. You need to become familiar and don't be scared with accounting terminology. I noticed Marvin was using some of that: debt service coverage, leverage, collateral, liquidity, and don't be afraid. All has everything that you hear, you're doing it today. They just use different terminology for it. And I gave you an example of what is an income statement, your checking account, and what is a balance sheet, what you own minus what you owe, give you your net worth. Okay, that is it for now. Okay, so we will walk through the various financial statements of a business. And anytime you want to stop me, please go right ahead. Let me preface by saying that this pandemic brought to light how much the fact that some entrepreneurs neglected this aspect of the business, they're paying the price today. And very likely because of that, many of those will be businesses that will not survive. Sad. Every time I'm confronted with one of those, it is very, very sad. These are people, these are individuals that put their hard-earned savings into opening a business. They put a lot of hours, them and their families put a lot of hours to run this business. All of a sudden, here comes a setback, which, by the way, now is a pandemic. I went through three of those. Call it something else. Economic distress. We had a housing crisis many years ago. There's always been, every 8 to 10 years, there have been a major economic crisis that if your business is not well positioned, you could go under. And it's a shame that all the sacrifices and money you put in disappears. Okay, so keep that in mind. You might not like accounting, you might not like finance, but it's the heart of your business. Okay, and it's where your money is. Don't ignore that. Again, I'm sad because many people that I'm seeing today, that's what they have done. Let's take a look at the profit statement. I gave you an example with your checking account. So when you put in here what you show your revenues, your sales. Okay, then the next step that comes in, you have something that is called gross margins right there, number 3. What is a gross margin? Is you buy a, let's see what product that I can tell you to use as an example. I gotta go to, I have a client of ours that owns a machine tool manufacturing. Has owned this place for, inherited from his grandfather, and he himself has owned it for over 20 years. He buys metals, and that metal are converted into parts. People call him, I want you to make this widget for me. Right now, recently, he was doing parts for ventilators that the hospitals needed. Okay, so that's what he was doing. He was buying aluminum, he was forming the aluminum, he was welding, he was doing whatever the requirements were, and then comes out with a finished product. But to do that, he needed to buy all these things. And in addition to do that, in order to generate that one ventilator, he needs to pay the people. He needs to pay rent. He has expenses, and yet he has not yet collected a nickel. Okay, so you have to know what your numbers are to do that. You got to know how your business operates, and you got to pay attention. Gross margins, and I'll talk this in a minute, is you don't control that cost. And I'll tell you why you don't control it. Let's go back to number 1. So you need to analyze the statement under a constant percentage. Why do I like to do a constant format? Is because one year you sell $10,000, the next year you sell $20,000. Okay, oh, I'm doing better. What you don't realize is that in order to sell that $20,000, you spend a lot more money to generate that $20,000 that you were doing with 10. So maybe selling $20,000, you're not going to make more money. I is has in the past, when I was dealing with businesses, larger business, people used to come and said, I have the opportunity to double my sales. I says, no, you do not. You do not have money to grow. Takes money to grow. Growing is not just more sales. And later on, I'll explain to you why. And that's what Marvin was referring to part of his presentation as cash flow. One thing in the business is profit. Another thing in the business is cash flow. And I'm not going to touch that one for now. Just put it in the back of your mind. So in order to do that, the best way to see how your business is doing, you say, okay, this expense when I was doing $10,000 was 3% of sales. Now that I'm doing $20,000, what is that expense? Well, maybe in some cases you create some efficiency. That expense, instead of 3, is now 2, because you maximize the utilization of those dollars. And that's the advantage of having a constant format, percentages, percentage of every expense to sale. And you have to create a common denominator for a business is sales. It could be others, but to make it simple now is sales. So what is payable to sales? What is cost of goods sold to sales? What is everything to sales? And you compare percentages. And that you know in which direction the business is going. You need to monitor the sales trend. There was an individual, very famous, well known for rebuilding companies. He died before most of you were born. His name was Lee Iacocca. You know the car manufacturing company called Chrysler Corporation. Well, Chrysler Corporation was about to go under, and they brought Lee Iacocca, and he turned that company back up, okay, tremendously. Okay, Lee Iacocca always said, he said many good things. I read every book he wrote. He said many good things, and one of them says, if you're not moving up in sales, you're going backwards in the business. Because let's face it, okay, if you don't move up in sales, your competitor is taking those sales, and you don't want that to happen. So in business, you do not make an investment, open a business, and sit at home and do nothing. You got to reinvent all the time. How can I do what I do better? How can I do what I do different? How can I add more features to what I'm doing? How can I add new products? As a business owner, and if you're in an entrepreneur class, this has to be a perfect, perfect fit for you. A good entrepreneur is always thinking, how can I do better tomorrow? So never be satisfied. If you sold 10,000 this year, you want to sell something logical. You want to sell 15,000 or 20,000 next year, and on and on. You want to add a new product. You want to do this. You want to do that. In other words, what you're doing is you are creating value for your business. Remember those 2 words, create value. I had that in front of my desk for most of my career. I wanted to know how I create value for my employer. I still use it. I want to know how I can create value for those business owners that come to see us for our help. So create value, create value. Put that in your brain, please, because that's how you're going to be successful. So you got to monitor the sales trend, and you got to do that by week, by month, by quarter, whatever is meaningful to you. Uh, and as I mentioned, make sure that those changes in the income statement are later going to affect your balance sheet. We'll talk about that. Gross margins. You don't control gross margin. You don't control the cost of sales. Okay? Because today I was helping somebody that is opening a wine store with food service. Okay, these people are going. It's a brand new business. They're going to invest 250. I'm sorry, no, they're going to invest $150,000. They are asking us, asking Marvin, not yet, but he doesn't know that. They're coming to him. I've been working with them for 3 weeks in putting all the plan together. So they're coming to him to ask for $250,000. And so they're putting 150, 250, 400. That's what it's going to take to get that business going. And what I was telling them today, explaining that item about cost of goods sold. Well, cost of goods sold, you're going to sell a bottle of wine for $20. That bottle of wine, it costs you maybe $8. You better, and that is going to be shown as a cost of sales. Okay, now that bottle of wine tomorrow goes up to $10. Okay, what about if you cannot sell it for more than 20? If you're not going to sell much for more than 20, how are you going to manage that? And the only way you're going to know that is by watching your cost of sales, which is also known as cost of goods sold. Okay, and make adjustments in the business to see how is my business going to assimilate, okay, the increased price in my bottle of wine, and without having to increase my own price. Ideally, what you do is my price was from 8 to 10. My sale price is going to go from 20 to 22 or 23, somewhere in there. Okay, but you need to know that. You need to be on top of that. Okay, the same thing. You going back to the example that I gave you, your checking account. Okay, your what happened? Let's say your cable fee, or okay, it goes up $10 a month, and if you're not making any more money on salary, what are you going to do? You're going to get rid of cable. You're going to make some other adjustments in your operating on your living expenses to accommodate $10 of cable because you like cable. You like internet. You need internet today. So you cannot sacrifice that. Same thing in the business. The same decisions you're making today in your life will be applicable to the business. Don't, as I said, don't try to make it very complicated. Okay? Very important for a business. Number 4, very important for a business, most business, is payroll cost. Payroll cost could be very high because it's not only payroll costs, you have to pay taxes, you have to do payroll processing, okay? And you want to monitor. I'm spending today, I'm selling $10,000 a year, and I'm spending $1,000 in payroll, okay? So you divide the sales by your payroll cost, and it's an indicator of efficiency. Tomorrow, your sales are going to go up to $20,000, and your payroll expense is only going to go up to $1,500. You're becoming more efficient. You're maximizing the use of that key expense for most business, which is called payroll. Okay, that's one thing in most business you have to watch. Whether it's a restaurant, with it's a part manufacturer, with any most business. I don't know of any business unless you are your own. Let's say you are a consultant or you're in the computer service business that you are the only employee. Then, well, then you have to worry about because you're not making as much money. But always monitor sales to payroll expense. Very important. Okay. Let's look at monitor the percentage of each operating expense to sale. As I told you before, sales go up, but you cannot afford to let the percentage of expense to sales to go in the wrong direction. If you're spending 3%, let's say for marketing today, and your sales are going up, you say, well, I might be able to spend 3.25% on marketing, no more than that, because otherwise my profits will go away. Okay. Let me go back for a moment for gross margin. In gross margin, you have your sales, your cost of sales that you don't control because somebody else sets out that pricing, and you have a gross profit. That profit as a percentage of sale is called gross margin. Your gross margin is 50 cents. Okay, that's what you have right off the bat. You have 50 cents to spend in the rest of your business, in marketing, in utilities, in payroll to the office, in gasoline, transportation, whatever is the expenses of the business. You cannot go more than 50 cents on your expenses. And that's the advantage, that if you look at a percentage, the percentage is saying that for every dollar of sales, okay, you're spending so much in payroll, so much in the computer service, so much in electricity, blah, 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 so much in marketing. And then hopefully, if you make 50 cents gross profits, you're going to spend at least, you should spend no more than 40 cents, is what we call below the line. Below the line is when you start, after the gross profit, you start showing all the business expense. I don't see going into the business if you're not going to make 10% on the bottom line. Okay. And you have to have your salary. Besides that, you have to have your salary. It's your profit, because your profit turns out later, and I'm crossing boundaries here, but your profit is going to come back later into return earnings. You're building the capital of your business. And I'll explain to you the importance later of building the capital of your business. So no business should work with less than 10% to start with. To be honest with you, I don't think a business should operate less than 25%, but you're not going to do that at the beginning.
Well,
That's
and Gonzalo, one of the things you mentioned that is really important is I see a lot of entrepreneurs that never budget a salary. It's
right.
not like they'll have a salary in the beginning, but eventually you want to have one, and therefore you need to budget that.
Mm-hmm. If you're going to replace yourself tomorrow with somebody else, is it going to come to work for free? Probably not. So it's good to plan on that. Then you go into net operating margin before depreciation. Let's see, do I touch depreciation now or later? Let's touch it later. There's two types of expenses. There is cash expenses and there is non-cash expenses. Well, let me touch on that right now because I want you to understand it. You buy a car, okay? You spend $5,000 in a car, same car we were using before. In your accounting systems, in the business, you are not going to show $5,000 as an expense for buying a car. It's somebody called the IRS that won't allow you to do that. So IRS has set up that every asset significant, I think is over 2,500 or something like that, must adhere to a depreciation table. They tell you that a computer needs to be depreciated in a couple of years. Okay. A car needs to be depreciated. And usually they do it by the life of the asset. So what you do, that $5,000, let's say it's a car and let's say it's 5 years, and let's say you pay $5,000 for it. That means as an expense, although you put the money out, the money already went out, but you cannot use it as an expense. Every year, you're going to be able to declare $1,000 of depreciation expense. Let me ask you a question. Are you putting out $1,000 every year? No. You already put out the $5,000. The depreciation is a recovery. It's a recovery of your money that you already spent. And they allow you to deduct it as an expense, but that is a non-cash item. You're not sending out $1,000 and you're not receiving $1,000. So it's a non-cash transaction every year. And that's what it's called, non-cash item. And that's what you see, that when they do actual operating margin for the business, they say before depreciation, because depreciation is an expense, but it's not really cash going out of the business. Okay. So it shows that number, net operating margin. It shows the operating cash available to cover other short-term working capital needs of the business. Okay, and I want to be sure I don't cross lines in here into cash flow because I think I will totally confuse you. So let's say that you made $10,000 of profit. I'm sorry to tell you, that's not how much cash you generated. How come? I have this. If I have that profit, I add back the depreciation that I use as an expense, that should be the cash I have. No, 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 no. Okay? Be aware of this. There is two things that are not being shown there. There are many, but two of them, the most critical one. For example, if you're going to sell on credit, you have to create something called accounts receivable. If you're going to sell on credit, that means people are not going to pay you for 30, sometimes 60, sometimes go beyond that. That means you sold $1,000, but you're not going to get $1,000 in cash. You're going to get an IOU from that person you sold that says, I'll pay you the $1,000 next month. How am I going to survive this month? That's called cash flow. You got to find a way that your business generate that cash so you can go on 2 months too. And it's not only receivables, is because that sale included payroll, that sale included utilities, rent, and a number of other things that are daily expenses of the business. So keep in mind the difference, and we'll talk about that later. Keep about the difference between profits and cash flow. We were talking about net operating margin. Net operating margin is the percentage that your business is generating. Your business is generating 10% of sales in net operating margin, not net profit, not net cash flow, net operating margin. Keep that in mind. It's a percentage. And you want to know that, remember, you had 50 cents to spend. You should not spend more than 40 cents in the operating expenses. Your net operating margin is 10 cents. That's why I like to do the numbers with percentages. 10 cents. Now, out of that 10 cents, you got to cover other things. And we'll talk about that later. Am I making it too complicated for you? Raise your hand, please. I know I'm throwing a lot of stuff at you.
Well, I know this is the first introduction to this, and just to let you know, we have about probably 30 more minutes to cover whatever we have. And I know I'm going to be bringing Gonzalo back to follow up on some of these ideas, but we have about 30 minutes, Gonzalo.
And we're going to cover in more details. Okay, so don't be overwhelmed if some of these things are making you go crazy right now. The next statement that you need to know as an entrepreneur is your balance sheet. The income statement, the one we described above, is an everyday operation. It goes on every single day. Sometimes it stops at the end of the year because you have to declare taxes, but it keeps aggregating every single day. Balance sheet is not. The balance sheet is you take a picture of the business now at 7:28 at night on February 23rd. And that's your business. Tomorrow morning, when you open your business, that picture will probably change. It's a whole different picture. And the one you took today at 7:28 is meaningless because you have a whole different story. The balance sheet has three components. I mentioned it before when I was telling you, you run a balance sheet with your personal life. Okay, remember, you bought a car, you bought it with credit, you have a net worth, which is what the value of the car, and your credit plus whatever amount you have in cash. Boom, that's it. That's your net worth. Now, so that's a balance sheet. The components, okay, is changes as operation changes from the income statement. Okay. Now, as I mentioned before, if you're going to increase in sales, it's not just sell more, because if you're going to sell more, you're going to have to buy more inventory. You need cash for that. You need to generate more account receivables that you're not going to get the money right away, but you need to fund them. So you're going to need money for that. You may have to buy some equipment. That equipment, remember I told you, is like a car that you pay $5,000, but you don't get to expense that. That is going to go into depreciation. So you need to have cash to support that. Okay. I tell the people that 3 things you need to know. Okay. When you run a business, particularly a small business, and you go home at night, 3 things you need to know. How much cash do I have in my books? Not how much cash you have in the bank, because the bank doesn't give you the true cash position. How much cash you have in your books in the business, number 1. Number 2, okay, did I break even? Or did my sales, and we'll talk about break even at the next session, don't worry about that. Did I break even? Were my sales and the margin that I make on my sales enough to cover my operating expenses? Yes. And number 3, and very important, is anybody owing me money that is not paying me as they agree? And you're not in the finance business, okay? You're in the restaurant business, you're in the tool manufacturing business, whatever it is, you're not to finance anybody. The next morning, when you walk into the office or into your business, you call John. John, you owe me $1,000. What happened? What do you think John is going to tell you? Oh, I forgot. I'm going to mail you the check right now. Is John mailing you the check? No way. 2 days go by, no check arrives. It's your money. Remember that. That's a priority. Okay. Then you call John. I never got my check. Oh, I put it in the drawer and I forgot to put a stamp and mail it. Don't buy it. Okay. He said, John, don't bother to mail it to me. I'm going to go in my car and get that check right now, or I'm going to send somebody. Put him on the spot. Okay. That's your money. Don't let anybody run. Break even sales, cash, and money that people owed you. Okay. Okay. So receivables are very important. That's what I want to make the emphasis on receivables. So you need to monitor those receivables. There is something called an aging, which tells you how many people owes you money within 30 days, how many people owe you money within 60 days. More than 60 days, forget it. You got to do something with it. Okay. Determine the funding sources to support the growth of assets. Okay. How are you going to grow your asset base? And that's the value of your company, is your assets. Okay. You're going to have cash from operation, which is very good. If you can grow with your own cash, you're running a fantastic business. Sometimes it's not possible. Sometimes you have to borrow money to make money because the opportunity presents itself and you want to take advantage. So business debt / liabilities. And last but not least, capital infusion. Remember that I told you that you want to make enough money to cover your salary, to leave something behind in the company. I had a client about a month ago. I have the opportunity to buy somebody, but I don't have any more debt capacity. He's max on the amount of borrowings he can make. I said, what is your return earnings? Oh, he tells me they're negative. I knew they were negative. I said, they're negative. I said, you cannot buy that business. You have no money. Nobody's going to lend you money. Well, I'm sorry, I shouldn't say nobody's going to lend you money. Somebody will lend you money if you pay 40% interest rate. So I tell the people there is 99% of the people that are looking for money can find a borrower. It depends how much you're willing to pay or can afford to pay. So return earnings in a business is very important. So when the opportunity comes, you can take advantage of that. And later we'll talk about all that in more detail. When you're going to ask for money, okay, which is one of the opportunities, one of the ways that you can take advantage of opportunities. Like, for example, you have an opportunity to double your sales, but you're going to need money for receivables and inventory. Okay, well, borrow that money. That's what Marvin does. Okay, and he provides you the money, provided that everything else is along the way. So you got to borrow. If there's short-term working capital, remember that term, short-term working capital. What is a short-term working capital? Receivables, inventory. These are things that are constantly turning. And you borrow money to finance the cash gaps that exist between the time you start buying inventory, the time you produce your product, to the time you sell it, to the time you collect the money. That's called the working capital cycle. That's how your business work. Short-term working capital cycle. Okay? Remember, buy inventory, produce the item, pay your expenses, spend 30 days to collect your receivable, and then gonna get money back in the business. That's working capital. So you can borrow to do that. And if you demonstrate to the lender how that cycle is, Marvin was telling you, you gotta know your business. And when you go into business, you gotta know your working capital cycle. Individuals like us, the advisors that Ray has on this organization, can help you navigate through all this at the beginning. That's the beauty. Okay. You don't have to do this alone. If you ever want to go into the business, you call that SBDC office, and I tell you, how many do you have right now? 28, Ray? I didn't hear you. You're muted.
We have 40.
40. Wow. You see how far behind I am? We used to be 28, and he has elevated this thing to 40 now. Wow. So we can help you. And you have expertise here everywhere, from finance to accounting to legal to international to website development to marketing, anything. We can provide assistance on anything. And so now you're financing that. You do not want to finance long-term assets. What are the long-term assets? The fixed assets, the trucks, the buildings, the tenant improvements. All those things are long-term assets. If you want to finance a long-term asset, you have to have a long-term loan. Much. Why? Because that long-term loan will go along, if it's well structured, will go along with your depreciation that you are going to claim every year from your taxes. So guess who's going to make the loan payments for that loan? Yourself, your business, through depreciation, effective use of depreciation, and effective blend of depreciation and debt. So that's part of what you learn. Okay. So in other cases, when you don't do that, people use and spend depreciation. No, save depreciation, because eventually that asset, that truck, is going to have to be replaced. And if you have saved depreciation, you're going to have to borrow very little. So keep that. As I mentioned before, you keep control of the agent. The same way you keep control of the agents for receivables, be respectful of the people that you owe money to. I tell you that many businesses these days, the vendors, they are called vendors, the one who provide the cost of goods, the cost of goods sold to you, refuse to sell them on credit anymore. Pay on delivery, no payment, no merchandise. That's tough for a business. That's very tough for the business. So keep your credit in good standing with your vendors, because the moment you need them to give you an extra 15 days, an extra 30 days, they will do it to you. And that's the cheapest money you can buy. You can rent. Okay. That's a loan that you pay no interest. So keep that in mind. Okay. There has to be a relationship between the amount of money that you allow your customers to keep for 30, 60 days and the amount of money you are allowed to keep from your vendors. Those two need to go hand in hand. I like to establish, if it's never going to, well, I should say never, seldom is 1-to-1, but it should maintain the same ratio. If your accounts payable is about 70% of your accounts receivable, and you can manage that through your cash, and you keep that ratio, you're doing okay. Okay, so that's another thing you have to watch. You do not use, there's accounts called accrued assets and accrued liabilities. What it is an accounting terminology. I don't want to get into that. You don't have to pay taxes until March, for example, until the end of March. But every month you put a little bit aside to eventually pay those taxes. Okay, that's called accrued liabilities. You're accruing it, but you don't have to pay it yet. So that money is in some kind of a reserve account. Okay, and some people tend to use that. Oh, guess what? Here comes March 31st. I have to pay my taxes and I don't have the money. Boom, what do? Poor organization, poor business management. That's why, as a business owner, you need to know all this and you need to keep control of all these things that happen in your business. Finally, brings me to your equity account. That's your money. That's your money. Okay. And return earnings. Somebody had a typo there, Ray. It's earnings, not earnings. Okay. Somebody with an accent must have written that.
Yeah, I think so.
Yeah. I'm going to mark it here in my copy. I got to change it. So it should be used to cover the long-term needs and possible short-term. Another one. Wow, this is a bad paragraph. Emergencies. Woo. Right. That's a shame that whoever typed this is horrible. So equity account should have return earnings, as I told you before, is the way that you're going to be able to allow your business to grow without borrowing 100% of what you need. Always keep some money in the bag so that you can use. Ray, you want to stop here and have them ask question and leave the other one for the next session, which is cash flow? Unmute you, unmute. Ray, unmute.
Yeah.
There you
All
are.
right. And again, I really appreciate your time. So we'll stop the recording at this point, but we'll continue another time. But we'll open it up for questions.